Hi students, good morning. Um, just confirming that you all can hear me fine. Can you all hear me fine? Right, okay, good. So today we shall be reviewing what we did last week, and we're also going to take a look. Okay, Chelsea, thanks. We're also going to look at your first in-course assignment, and then we are going to do depreciation again, and we're going to introduce today. Actually, we're just going to do another depreciation lecture today. Yeah. All right. So let's go. So in reviewing project management, I know we did project management last week, and we looked at request for proposal as well. We defined what a project is, um, and the second point in slide number 2 is understanding that the primary challenge of project management is to achieve all of the goals of the project whilst honoring preconceived notions. That's important. Lewis said that the project never fails because of tools and methodology, it fails because of people. So the people, having the right persons in your project team is a very, very important thing. Just as it's very important to have the right persons in your organization as a whole. But remember, we have been saying that projects usually have high performance team members that are very skilled, that work with least amount of supervision, and they are the ones that make projects successful. Why is project management so commonplace today? Because of the need for speed, because of identifying within your organization groups of persons that are high performers, high achievers, that can get things done, that can find solutions without having to hire specifically in that in that in that particular area. Right, project team members are usually very receptive to new ideas, and the success of the project depends on the success of the team. Projects usually have better cost control because the project manager controls all the resources, and again, because you don't have the amount of bureaucracy and you don't have the amount of approvals that are needed. At times, things can run very, very efficiently. Most times. However, there are some disadvantages with using a project structure, the stability, the career path. Although I explained in the lecture that the stability might be poor because projects may last 1 year, 2 years, 6 months. However, by being part of projects, it now puts something very, very, very relevant on your resume that you would have participated in this project, and it positions you well for job positions and other projects. So we compare the functional manager versus the project manager, and we all appreciate that the functional manager is one that is a specialist in their field. For example, you guys are going to be pharmacists, and if you are the leader of a pharmacy department, the manager of a pharmacy department, you may have to bring in, or your boss, your CEO, might bring in a project manager to get something done that involves your pharmacy department. So you'll be working with the project manager to get these things done. But they're two distinct roles. Also, as the pharmacist, if you have the particular training and the capacity to also be a project manager, that's also possible. All right. But we want to just still be able to make the distinction between a functional manager and a project manager. A functional manager is usually a specialist in their area. They don't know much about project management. They don't know much about about schedules and all of these fancy stuff that project managers do. They may not be a high performance um, manager, so they may not have um, project management skills and traits and characteristics. But they can assist the project manager. All right, and you compare the functional versus the project manager on slides 8 and 9. And slide 10 would now take you into the skills of a project manager: strong team building and setting a positive tone. And nothing, absolutely nothing is wrong. And it should be something that you can try and get to in your own life as a manager, whether it be in the future, whenever that is in the future. If you adopt a project management approach as a manager, it's going to augur well for how well it's going to do well for how your performance is going to be as a manager. Strong team building skills, setting a positive tone, great interpersonal skills, communication, discipline. Discipline is very important, very, very important. And then West went on to talk about the 7 habits that a project manager will have. Begin with the end in mind, results oriented. And I said, this is similar. This is similar to having a vision. The same way that we've been talking about in management in these courses, that having a vision of something grand yet simple, that's way ahead, is what you're going to be working with come back. So you start thinking with the end in mind. All right. Getting your priorities. I don't know if I mentioned this, but at times when you have a whole list of things to get done, this is just from your own personal life. If you're as a student, you have several exams, you may have some work at home to do, you may have some co-curricular activities to get done, and you have lots of demands on your time. Sometimes something as simple as writing down everything without putting it in priority, but just writing down the list of things that you have to get done. And then after looking at it, then you can now put one, two, three, and list on and put on your page of things to get done the priority. So simple methods can help you to develop prioritization skills. Thinking win-win, to be skillful, and from our conflict management, remember win-win is collaborators. So project managers collaborate. Seek first to understand, then to be understood. Being a skillful negotiator, you must understand what it is you're going to get into before you can now be part of it. Seek first to understand, then to be understood. Always be proactive. Just one characteristic of project managers are always proactive. They are hardly they are more proactive than reactive. They're always thinking ahead, always synthesizing, always trying to make sense of all the information that's there, all the resources that they have that they can now use to create, constantly sharpening the sword, constantly learning and growing. And then we have the list there on slide number 12 of why projects succeed. Slide 13 talks about the different specialist areas of management that project management use: scope management, time management, procurement, risk, etc. And then we went on to talk about project overview statement. Why do we want the project? Um, to try our best and get it quantifiable, whether the project will be successful or not. And one of the success criteria for all projects, as seen in slide number 16: increase in revenue, decrease in cost, improvement in services. That's your baseline. Either we're looking for an increase in revenue, or we're looking to decrease operational costs, or we're looking for some improvement in services. That's generally what most projects are aimed towards. So the competitive advantage that projects do to an organization, and best just from our very first initial classes, you can answer this question: efficiency, improved quality, being innovative, and having improved customer responsiveness. Those things are some real building blocks for your competitive advantage. I urge all of those students who are in community class as well, community in pharmacy management, as a potential business owner, as a small entrepreneur. These are four very important elements that you should always have present in your business. I would like to see when you do your business plan, these elements expressed, these elements established, these elements talked about in your business plan to give you competitive advantage. Always look at efficiency, always look at high quality, and you will be here. It has the word is quality is there, but it's a presumption of the quality being high. Always be innovative and always be as responsive to your customers as you can. All right. There are always assumptions and risks when doing things. The risk are those things that have no control over in project management. And understand that your project overview statement must address those three main audiences: the senior management, your customer, and your project team. So if you are the project manager, you have three main groups three main parties that you need to address. People who are above, who may be the ones who have hired you, the customer, and your project team. Customer meaning um, sometimes it could be your direct cash customer that's coming in to, and making purchases in your organization. And your project team is those persons around you who need to know what is going on, what is the plan. And we went on to look at an RFP, and I know I said that there was an RFP in your packet note package, a Word document, AVP Medical, I believe. RFP is generally an external document, and you can't when the service that is required for an organization cannot be found inside. An RFP is usually sent out. An RFP means request for proposal. RFPs look at RFPs must have, and we're on slide 23, must have a concise understanding of what the problem is, the need, or the business opportunity. It must have a statement of works, the customer requirements, and the deliverables that are expected. RFPs should be as clear as is possible, and the potential contractor who's responding to the RFP should know what the requirements are for the response, whether be it you are the details that are necessary from the customer in the RFP. Evaluation criteria of RFP would be similarity with projects, technical approach, schedules, cost. And I remember asking you all, if you're a brand new company and you don't have any experience, what can be used in replacement of that experience? And we all agreed that it was the the competency of your staff and the experience that they would have had from the past that they're now coming into your company. Their technical competence, their qualifications are what are usually used in replacement of experience. I'm not saying that it's better, but I'm saying that it because you may have a brand new company, it doesn't mean that you won't get projects. It's how you do your how you create your proposal, and the persons and the individuals and the groups or the associations you have with your company can put you in a position to get the nod. The Contractors at proposal, sorry, should have the approach, the deliverables, the schedule, experience, staffing, costs. The technical component of the contractor's response should have some clear themes, the understanding of the problem, the, the proposed solution and the approach, and to technically demonstrate the benefits to the customer. You, as the manager, need to pay attention to the proposal that's in front of you. Look at the description, look at the deliverables, look at the project schedule, look at the organization and the related experience as we spoke about earlier. Be careful about costs. We spoke about costs. We spoke about costs in the last class. There are times a contractor may want to bid for a project and they might have a very attractive bid, but whilst in the project, there's something called cost overruns that can now sometimes double the initial cost of the project, double and triple. You need to have protection in your RFPs that these things don't happen beyond acceptable standards in the industry. Always look for escalation and contingency plans in your proposals. And the potential contractor must always keep in mind the budget of the customer, the competition that's out there. There will be several other persons who will be competing for the project. Good, reliable cost estimates. And I remember mentioning to you all that there is somebody called, in construction, there's someone called a QS. Put it in there again. A QS quantity surveyor. Right, so this person, the QS or the quantity surveyor, is usually someone who is well in tune with what the market has available for certain items. So let's just use as something simple as nails. Um, the contractor is putting in a cost of $10 per box of nails, but the reality of the market is that anywhere you go, the average price of nails would be $7 per box. This is where your quantity surveyor can now. The quantity surveyor is usually hired by the customer to ensure that the contractor who is coming in to do their project is giving a realistic cost estimate. All right. So these are things that you need to look at when evaluating the proposal. And of course, we don't want to plan too little and we don't want to plan too much. Um, failure for planning for risk, very important. And monitoring and evaluation. So that was the project management lecture. And then we went on to any questions before we go on to the review of the other lecture. Any questions on project management? Now, guys and gals, I remember I said that project management is a specialist field, and I will encourage you all. I've been encouraging all of you from the beginning to think beyond your core competency of being a pharmacist. I encourage you all to do further postgraduate work in management, whether be it an health administration, whether be it an MBA, whether be it a diploma in project management, or even a master's in project management. I would actually strongly suggest that you all do postgraduate work, postgraduate qualifications in management if it is you do feel encouraged to do so. No questions. All right, so let's go straight to the financial lecture. And I said that my PowerPoint presentation was a condensation of a PDF file that was sent on financial statements. I hope everyone had a look through, listen to the lecture, so that you can have a better appreciation for what was done last week. All right, so financial lecture. Just making sure no questions on project. All right, financial. Financial statements. Let me ask you a question. What is GAAP? And you all have 1 minute to answer the question. What is GAAP? Hoping that the 1 minute will be too short for you all to do a quick Google search. Question time, guys. Interaction time. What is GAAP? I knew it. I knew it. I knew it. Nobody remembered. Katrina and Chelsea, only because both of you responded to me this morning. Generally accepted accounting principles, Kavita R. Samantha C. correct. Kavita R. correct. Katrina R. correct. Okay, good. Very good. So it's generally accepted accounting principles, and that relates to the formulation of financial statements. Financial statements are uh, sheets of information that give an accurate picture of the company's financial affairs within a given year. These are done according to generally accepted accounting principles. The four types: the balance sheet, the income statement, cash flow. Income statement is also called the profit and loss statement. Cash flow, changes in financial position, and changes in shareholders' equity. And what's the formula that you all need to remember for balance sheet? What's the formula that I wanted you all to remember? Assets equal assets equal assets equal owner's liability plus owner's equity. Correct. 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 Okay, good. So that's the formula you need to remember. Assets equal liabilities plus owner's equity, because you could never tell in the exam, in an exam, it may not be finals or whatever, but you might see it a little different. You might see owner's equity is assets minus liabilities. And it's a mathematical formula. You all are very familiar with mathematics, so it can change up. It remains to say assets equal liabilities plus owner's equity. And what are your assets? Assets can be defined as, can be categorized or classified as current and non-current. Current are those which can be converted to cash within a year. Non-current are those which cannot be converted to cash within a year. Current would be your inventory. Current would be accounts receivables. And your inventory can be merchandise or supply inventory. And supply inventory would be your consumables. Merchandise inventory is your stock for sale. Merchandise inventory is usually always the larger amount, because your inventory is usually a large amount compared to the pen, paper, computers, etc. Consumables. As I mentioned, computer would be considered a computer would be considered what? What type of asset? Computer is considered to be what type of asset? A fixed asset. That's right. A computer is considered a fixed asset. Thanks, Samantha A. So fixed assets are those items which will cannot be converted into cash within the business year. Example, land and fixtures. The liabilities are what the business owes, current and non-current liabilities. Again, the categorization is similar. Current liabilities are that which you owe, that you owe within this financial year. And non-current would be the things that you owe beyond the financial year. And we can use a simple loan as the example. The current amount on the loan, meaning the amount that you pay within the 12 months of your financial year, is your current liability amount on that loan. The balance that you have remaining for the next 5, 6 years, that would be your non-current amount. That would be your non-current liability. So I hope you all understand that distinction. Excuse me 1 minute, right? Sorry about that. Yes, Jahil, explain which one, the liabilities part. So liabilities are current and non-current, just as assets are, meaning current meaning a current liability is that which you owe, that which the organization owes to someone, money going out within within the financial year that we are looking at. So let's just say, for example, we are looking at the financial year 2020 from January to December. Every month we may have a loan that's being paid. So January installment, February installment, March, April, May, June, July, August, September. All of these installments or mortgage payments within that financial year, that's considered your current liability on that loan. However, the loan is for 10 years. Therefore, the let's just say this is the first year that you're paying your loan. So the other 9 years that are remaining is considered the non-current part of the loan. Understand, Jahil? So the current part is the amount that is paid out, that is owed within the financial year, and the non-current part is that which is owed outside of the financial year. Jahil, just give me a note there to let me know if you understand. Yes, okay, good. Right. And we were at right, and then the owner's equity is that which remains from taking away your liabilities from your assets. It's also called your net worth. And owner's equity can be invested capital, that which is put into the organization, or that which remains in the bank account. Right. So that's what they look at for owner's equity. The income statement, also called gives you the net income, sorry, the net profit or the net earnings. It's also called the profit and loss statement. It looks at your revenue, um, subtracted from, well, your cash and credit sales that are taken away from your revenue. Sorry, my apologies. The net income is your revenue minus your expenses. Your revenue is all your cash and credit sales, and your expenses are all of your overheads plus something called cost of goods sold. And remind me again, can someone remind me, I'm asking the question, when does your inventory become an expense? When does your inventory become an expense? Because you would have seen in the first couple slides in the lecture that inventory is an asset. So when does inventory become an expense? Can someone remind me? When does inventory become an expense? When it is sold. That's right. So when your inventory is sold, it's called cost of goods sold. And that's an expense that is used to calculate your income statement. Very good, Samantha C. Thank you. Samantha A, Chelsea, all of you all who answered correctly so far, very good. Thank you. And then we have at the bottom of slide number 10. Cost of goods sold is your beginning inventory plus your purchases minus the ending inventory. That's what is used when calculating and doing up your financial statements. Cost of goods available for sale is just simply your beginning purchases, your beginning inventory, sorry, and your purchases. And retained earnings or changes in equity is what was left or what was withdrawn or what was invested. The cash flow statement, also called the sources and uses statement, it's a very reliable statement because cash is difficult to manipulate. Cash is usually generated from operating activities, investing activities, and financing activities, and that the acronym is OIF. We then went on to talk about the two accounting methods, cash accounting versus accrual accounting. Accrual accounting, revenues recorded when the goods and services are delivered. Cash and credit sales are recorded as revenue. Expenses are recorded either in the same period that it was made or the period that is actually paid out. So accrual expense is usually the accounting methods that most pharmacies use. And then we went on to touch on depreciation, and we're going to look at we have a separate PowerPoint for depreciation for you. So I hope I can have enough time to, yes, we are able to. So depreciation is, as you would know, just as it sounds, something that reduces in value as time passes on. And that applies to most of your fixed asset registry or your non-current assets. Um, and it does not apply to land. We explain that it doesn't apply to land because land can be repurposed. Land, yes, oh, I'm not seeing Precious answer, yes, when it is sold. Land can be repurposed, land can be reused, land, as we say, land will rot, right? So land is not something that depreciates except for the very, very rare circumstances that makes it unusable, a black hole, a sinkhole, nuclear waste. So several very rare circumstances where land will no longer be considered to be useful or functional, or so that's when depreciation may apply. But generally speaking, it doesn't apply to land. And for depreciation, we need to know a few things. We need to know the acquisition cost, and remember I said acquisition cost is the raw cost of the item plus any other cost needed to get the item working. And I used the word commissioning last time. I hope I get the spelling correct. Commissioning. Commissioning of equipment. You would see in organizations they have a very expensive piece of equipment, and the equipment is commissioned. It means that it was bought, it was installed, and then there were other things that needed to get done for it to work. So all of those costs that are needed to get it to work is called the acquisition cost. N, or the useful life, is the number of years which the item the item can have use. R is the salvage value or the residual value, and your depreciation expense is your cost, your acquisition cost minus your residual value. And the depreciation rate is 1 over n, and n being the number of life years that the equipment has. So the two methods for calculating depreciation is the straight line method and the accelerated method. The straight line method is very straightforward, where the same amount of depreciation expense is applied to each year. Accelerated methods, however, are a little different. They have earlier years have a lot more depreciation than later years. And we have two types: the sum of digit years and the double declining method. The sum of digit years um, looks at, well, there's a formula there that you would see in the PowerPoint and you would see in your PDF as well. The double declining method is also a formula, but double declining method looks at book value. Book value is the acquisition cost minus the accumulated depreciation. Accumulated depreciation from your mathematics would be the addition of the amount of depreciation expense each year. And then finally, I mentioned to you all about financial versus tax accounting and how depreciation can affect whether you are doing accounts for the bank or whether you're doing accounts for tax generation. These are accepted methods that are used internationally when doing your financial reports. If the depreciation method that is chosen can determine if you have accounts that are suited for financial purposes, for purposes of the bank looking at your organization more favorably for a loan, or your depreciation expense can be used to make your accounting look sufficient. Nobody wants to be paying excess in taxes, and nobody wants to be paying. Um, Nobody wants to look and have their company look as though it's struggling. So depreciation expense is one of those things that can be used um, to let me see if I get the right word. Depreciation expense is one of those methods that accountants use to generate either financial accounts or tax accounts, depending on the purpose and the need of the statement. All right, so that's it. That was the financial lecture. I can probably what we'll do, I'll just do the other depreciation lecture that I have here. So when we come back from 10 o'clock, I will do the review of your exam and then get started on the other lecture. All right, so let me just, if you pull up your notes, there is a lecture here called Depreciation, Chapter 2, Depreciation Edited. You can open up that. This was one that it's just to help recap and to look over in a little more detail the depreciation lecture we just looked at. It applies to your fixed depreciation applies to your fixed assets, those that have high cost, long life, and it's used. Those the thing that you look at is high cost, the life and the use in business. And we saw that it does have the same things we talk about: the acquisition cost, the number of useful years, and the residual value. And this here looked at an auto dispense system that was costing $100,000. And the example is going to look at the the three different types of depreciation expense calculations and what you're going to get. All right, using the straight line method, um, cost minus residual value divided over divided over 5, and that would be a depreciation expense of 20,000 per year. Using the accelerated methods, the sum of digit years, take a look. We're on slide number 8 of this one. Cost minus residual value multiplied by the depreciation rate of 5 over 15, and as you can see, n is the total number of useful years, which would be 5, 1 plus 2 plus 3 plus 4 plus 5, and you get 15 years. And then the rate is starting from somewhere there, right? Right, so it's in descending order. It's in descending order, starting from year 5, year 4, year 3, year 2, year 1, and you would see the depreciation expense reduces dramatically every year. And the double declining method looks at, again, book value. Book value is the cost minus accumulated depreciation. Depreciation expense is the book value multiplied by 2 times the depreciation rate. The final year depreciation generally, and I want to remind everyone of this, the final year depreciation using double declining method is usually not based on a formula, but would be based on what is remaining, because the depreciation expense cannot be more than the residual or the salvage value. And on slide number 11, you're going to look at the comparison of all 3 depreciation costing methods. And you will see they all produce the same result, the same total amount of depreciation, but in each year, the depreciation expense is different. And you can see that it goes down gradually with sum of digit years and double declining method. And in the last year of the double declining method, it's just the right amount to get the depreciation expense to be 0. All right. So that is the example of the calculation for depreciation expense. And again, it brings up the idea of tax versus financial accounting. And I want you to see that the different methods can change 2 things, change your net income. Take a look on slide number 13. You would see using the straight line method can make your net income look as 19,500, and your sum of digit years can make your net income 10,800. So this is what we're talking about, that can alter your accounting methods depending on the purpose in which you want to do your accounts. All right, so understand that depreciation expense is one of those things that can be used to generate different figures that are needed accordingly based on the type of accounts that you're doing, whether it be financial accounts or tax accounts. Okay, right. So if you have do you have any questions on anything that we've done so far? If no questions, we want to go for the break, and then we'll come back on the other side of 10 o'clock and look at your first in-course assignment review. I hope you all had a look at the PDF on the financial lecture PDF. It will just give another example of calculating your depreciation expense. Any questions? Any queries? I just want to say to you all, look at these calculations in a very simple simple mindset. It's because it's very basic math. You're doing a lot more difficult things with pharmacokinetics. I believe it's pharmacokinetics that Dr. Pandey teaches. So this is simple maths. It's not complicated. It's very, very simple maths. Once you know what the different items are and you apply your formula, you'll be perfect. You'll be fine. All right. This is an easy way to get marks in your exam. All right. So no questions. We'll go for the break now, and we shall return at 10:05. Right. We'll see you at the other side of 10 o'clock.